Good morning, everyone. Welcome you all. My name is 𝘜𝘯𝘥𝘬𝘧𝑗, and I'm going to be your host for today. Okay, welcome everyone. As they are still entering, we're just doing a minute whilst they're still entering. Welcome you everyone. My name is 𝘜𝘯𝘥𝘬𝘧𝑗, and I'm going to be your host for today. We welcome you to our webinar. Our webinar topic today is understanding financial statements and how to use them to leverage your business. And we have today with us Mrs. 𝘜𝘯𝘥𝘪𝘯𝘨, who's an audit senior at 𝘜𝘯𝘥𝘪𝘯𝘨, and who's going to be taking you through our webinar for today. We at 𝘜𝘯𝘥𝘪𝘯𝘨, we are a dynamic and professional accounting firm based in Midrand. We have branches in Zimbabwe, in UK, and we call ourselves accountability partners as we live by it daily. As you know, financial statements are very important for an organization because it shows the financial health of an organization, as well as it provides insights. As for our services today, at 𝘜𝘯𝘥𝘪𝘯𝘨, we offer a variety of services where we do company registration and we do company amendments. We also offer consulting services, which are business processes, as well as performance management setup. We also conduct audit readiness, internal audit services, as well as payroll services. We also offer tax services where we look at tax disputes and tax opinion, as well as other specialized services that we give. And we also have accounting services where we look at bookkeeping and then management of accounts, as well as the review of financial statements. We also have human resources that we offer to our clients when they sign up with us. For today, I'm gonna leave it to our speaker for today, Mrs. 𝘜𝘯𝘥𝘪𝘯𝘥𝘪𝘯𝘕, but before she has done that, we're just gonna wait for a few minutes for other people to be coming in. Thank you so much for everyone who's joining in. Thank you so much as they continue joining in. Just give us a minute. Okay, thank you again, everyone who's joined. We just want to remind everyone that we want to make this webinar as interactive as possible. So if people can just write down, as we are going through the webinar, if people can just write down their questions, and then when we come to the question and session answer, then we will be having the questions, and then we'll be able to assist you in terms of the responses. Thank you, Mel, for joining us.
All right, thank you so much, 𝘜𝘯𝘥𝘪𝘯𝘀. Welcome to the webinar, everyone. I think 𝘜𝘯𝘥𝘪 has already given an introduction about me. So let's dive into the topic for today. So before we start talking about analyzing financial statements, we just need to do a poll time. Can you just help us identify who you are, whether you're a business owner, an accountant, an individual, or just specify? So I'm going to give you a minute to just respond on the poll, and then we'll continue with the webinar. All right. I'm hoping that everyone has helped us to identify who we're working with today. So on to the next. So on today's topic on interpreting financial statements, the first slide is about describing what financial statements are. So financial statements are basically formal records that provide a detail on the company's financial performance, the position, and also the cash flow. So what the financial statements do is that they help us to understand the business's financial health, and also from there on we can be able to make decisions, to make strategic decisions, and also just evaluate the performance of the entity. And then the importance of financial statements. So I'm not going to dive deep at this moment, but just an overview is that you can be able to assess the financial health of the organization, and then you can make financial decisions. You can also evaluate the financial performance of the entity, and then you can also assess the risks that are involved in the business. And types of financial statements. So with financial statements, we've got three main components in the financial statements. We've got income statement, we've got the balance sheet, and we also have the cash flow sheet. The income statement is basically the statement that shows a company's profitability over a specific period. So you can measure it in a quarter or in a year, or maybe even monthly if you want to. So what it shows is that it's also known as a profit and loss statement. So what it does, it has three main components, which is the revenue, it also has expenses, and then the main thing that you look at, which is the bottom line, is the net loss or the profit that you would have made. So the income statement is basically the one that shows you the profitability of the organization for a specific period. And then revenue, top line. So with revenue, it shows you the total money that you earned from goods or selling of goods or services. It is a crucial indicator of a business financial health, because there is no business that is running without wanting to actually earn revenue. So what that shows is that it will show you either growth, depending on the performance of the entity, to show you if there is growth, then it will be an indicator that there is an increase in customers, either also an increase in sales, or rather also higher prices. So analyzing the revenue would be able to also assist you with analyzing whether you've got a bigger market share. So if your revenue is increasing, it's a good indicator that you're getting a bigger market share. If it's decreasing, then you need to draw back and go back to the strategy. What is it that we're not doing? Because the market is actually closing on us. So you'll be able to analyze all that. And then in terms of profitability, if revenue grows and the expenses are controlled, then profits also will rise automatically in that line. And then valuation. So if your revenue is also increasing, it's also going to help with it's also going to increase the company's valuation if it ever happens to be valuated at any point in time. And then it also boosts investor confidence. So if you trying to obtain funding, it could be whether from your relative or a bank, there's no one who's going to invest in a company if they think that there's a decline in the performance, which the main line that they look at is the revenue. If I see that someone's revenue is increasing in an entity, it's going to automatically boost my confidence, and I'm going to be able to invest in that entity. Okay, and then so one of the issues that we recognize as an issue with one of our clients is that they do not understand how to recognize revenue. So they would recognize revenue based on their own understanding, but what they need to do is they need to understand the basics of revenue recognition. So in layman's terms, there's just a few criteria that revenue needs to meet before it can actually be recognized. The first one is that you need to have an agreement that is in existence. So in some forms, though, it's not necessarily an agreement that you'd have. For instance, in insurance, you'd have an agreement where if I'm the insurer, I would say that I've got an agreement with 𝘠𝘯𝘥𝘪𝘯𝘨 whom I'm insuring, and that contract would state exactly what the buyer and what the seller actually, whether the terms and the conditions for both the seller and the buyer. But there's certain products that you sell that you don't need an agreement. Like if you're selling bread at the store, you don't need an agreement. So in that line, the agreement it's not that you need to have an agreement, but it's what is this? What can I say? So it's something that it's already there. You don't need to have an agreement, but it's something that is already known that if someone comes to the store and buys bread, that is the agreement. It's not written down, but it's something that is already in practice. And then the second thing that you need to consider is the seller has the right to receive payment. So if I'm the insurer, in the contract, it needs to state that I have got the right to actually receive payment. And then the other thing that we need to recognize is the seller, needs to also have a performance obligation. So before I receive that payment, the contract should also state that I need to perform a certain transaction. So if I'm an insurer, I need to insure the person. I need to insure whether the company, the person, or the item, and that will be my performance obligation. If I do not do that, then the contract is going to fall away, or the revenue recognition is not going to meet the transaction rather will not meet the revenue recognition criteria. And then the third one is the seller should be able to estimate the amount of consideration to be received. So sometimes it can be explicit that in the contract to say this is the price, or sometimes it's based on practice that this is the price for this good, and anyone else would know that this is the expected good. So once that is known, then we're getting there to meeting the revenue recognition criteria. And then delivery of the promised goods or services. So the contract would also say the delivery of it, whether it's once in time, or whether it's at a point in time, or if it's over a period of time. And also that would also mean that the recognition of the revenue is going to differ. So if we've got a contract that says, I'm going to move away from the insurance. So if we're going to say that Star is going to deliver goods, however, I'm going to deliver them in portions, and the amount of consideration is 1 million, I need to deliver them in 5 parts. So I can only recognize the revenue if I've delivered one part and it's reasonable that I can measure it. If I can divide that 1 million into 5 for each of the 5 parts, then I'll only recognize the what is this? Is it 200,000 when I deliver the first part? The second part I recognize another one. So it's different depending on the type of delivery of the goods that you've got. So if it's if you deliver the good one point at a time, that would mean that you're